Hi, my name's Nick Brightville. I am with Hershey Financial Advisers. I wanted to come to you today to give you a brief update on what's going on in our economy, what we could expect here in the short term and into the rest of the year, and what that means for you ultimately. Over the last couple of years, we've all noticed this, right? Pulling up the chart here, prices have risen a ton in a lot of household items, right? A number of you would not expect that, a couple of years ago, your grocery bills would be 20, 30, 40% higher than what they once were. And a lot of you are probably, this is just a noticeable expense change, not necessarily life altering, but you have children, you have grandchildren who are walking through this, and it's concerning, right? And one of the aspects of inflation and what the Federal Reserve's been watching and how they're going to continue to move through with where interest rates are is highly scrutinized by what the inflation numbers are. So over the last rolling 12 months, headline CPI is just under 3% at 2.9. And if you look at a 3-month rolling factor for core CPI, it's actually below 2. So these are positive signs for the Fed to potentially go give their first rate cut in the mid-September meeting. What does that mean for you? What does that mean for portfolios and how things might function? Well, typically, pulling up this other chart here, if we are in a recession and we are moving into a recession after the first rate cut, you see the gray downward line here, the preceding 12 months are somewhere between maybe 15 to 20% negative. And we have that downward movement if there is actually a recession upon the first rate cut. If we have the first rate cut and there is not a recession, you are looking at the blue upward line of being up around roughly 15% over the next 12 months. So this is something to pay attention to, right? There's a lot of tells in the economy right now that things are strong, things are moving well. There are some dim spots, some concern about rising unemployment, and also concerns around other aspects of the tech market. AI, is the AI craze going to continue? And there's a number of things that we are watching. You got to remember that markets go up, markets go down, and it's a downward movement is very healthy. You can think of it as like a gardener pruning their rose garden or their vegetables, whatever this looks like to them. They are cutting off the things that are not producing so the new growth can come through and is more healthy. And conceptually, this is the same way that the markets work. About every year, equity markets drop about 5 to 10% and then recover. Every 2 years, you have maybe like a 10 to 15% drop. And then every roughly 3.5 years, you have a 20+% correction in the market. It's never fun to go through those things, but you have to remember that that is healthy. It is normal and reasonable for the markets to continue to move in that fashion. The consensus for the remainder of this year is that the market should likely continue on a positive pace. Now, that being said, pulling up my last chart here, there is roughly a 25% increase from July to November in volatility. This is an election year, as you all are well aware of, and leading into not just because it's an election year, but traditionally you are just moving into more volatility towards this latter part of the year until we get into the latter part of the fourth quarter, where you typically see a surge in stock prices because companies are running through the tape and doing it as well as they possibly can, looking to hit year-end sales and revenue goals in order to make their stock look as attractive as possible. But leading up to that, we're going to have a good bit of volatility. The consensus thought process on what the overall S&P rate of return was going to be this year before the year started was roughly around 10 or 12%. Well, the S&P is above that right now. So doesn't mean we're going to hit that target, could go above it, could go below it. But the consensus right now is that we are likely to finish positive, but it's going to be a rocky road, likely from now through early November until we get an elected president. Market typically pops after that point, and then there's a time frame where the market's going to figure out how it wants to move forward from there. So if you have any questions about things I said, concerns you have around your portfolio, please reach out to us. We are wanting to hear from you. We want to answer your questions, make sure that your portfolio mix is appropriate and correct and where you should be. And remember this as well, when we're investing for you and we're helping you with your retirement accounts, the business you sold, the property you sold, the money you're giving us to manage. We're managing it based on what your needs are, and then also based on the risk level you can handle on a given probability of outcome. So we don't chase returns and try to find the highest flying thing all the time. We really have to invest in a manner that what is the highest probability of outcome here, and making sure that you are investing with reasonable risk in order to hit your goals and to be able to live a life of financial independence. Thank you so much for watching this. If you like this video, please click the like button below. Please subscribe to our channel. There will be more videos like this and what we call evergreen content that is just simply educational to help you as you walk through your financial journey. Thanks so much for your time. Look forward to talking to you again soon.